Okay, so you see a headline, a company just made a massive profit. But where does all that cash actually go? How much of it ends up in your pocket as an investor, and how much gets siphoned off for taxes? Well, that's exactly what we're going to figure out. Think of this as your field guide, where we're digging right into the tax laws to see how it all works.
Right, so a company sitting on a pile of profit really has three main choices, They can pay it out to shareholders, that's dividends, they can keep it in the bank as reserves, or they can reinvest it. And here's the thing, each of those paths has totally different tax consequences, not just for the company, but for you. Let's unpack that.
So here's our game plan. First, we'll talk about why any of this matters. Then we'll get into the nitty-gritty, the tax on dividends, the tax on profits companies don't distribute, and another one for a special investment called a sukuk. Then, we'll wrap it all up and see how it all fits together.
So why even have all these different rules? Well, it's because tax laws are these incredibly powerful tools. They aren't just about collecting money. Nope. They're actually designed to influence what companies do with their profits, to kind of steer them towards either reinvesting for growth or sending that money back to investors to get the whole economy buzzing.
And to really get it, we're going straight to the source. We're going to look at the actual legal text for three key sections. That's 5, 5A, and 5AA, to see exactly how these incentives are baked right into the law. Let's start with the one you probably know best, dividends.
First up, Section 5, which is all about dividends. This is the classic way a company shares the wealth with its owners, these shareholders. So when you get a dividend payment, this is the rule that decides how much tax you're going to pay on it.
And here it is, the actual text of the law. I know. Legal jargon can look a little intimidating, right? But don't worry, we're just going to zero in on the most important part. See that phrase in subsection 2, gross amount of the dividend? That's the golden ticket. So what on earth does that actually mean for you?
Let's just break it down into 3 simple steps. First, a company pays you a dividend. Simple enough. Second, the entire amount, the whole shebang, before any fees or anything, that's what's taxable. Then third, a specific tax rate gets applied to that total number. It's really just a straightforward calculation on the full amount you get.
Now, there is one important exception here, which is laid out in subsection 3. And the rule is pretty easy to remember. If a dividend is already tax-exempt because of some other law, well, then this tax doesn't apply. It's basically there to prevent you from getting taxed twice on the same money.
Okay, so that's how the government taxes the money a company pays out. But what about the profits it decides to keep? That's where things get really interesting, and it's where Section 5A comes into play.
Here's the text for 5A, and a couple things should just pop right out at you. Notice these phrases, does not distribute at least 20% of its after-tax profits and that tax rate of 5%. But here's the real kicker. This isn't a tax on you, the investor. This is a tax on the company itself.
So you got to ask, why does this tax even exist? Well, it's all about giving companies a little nudge. The government is basically saying, hey, if you're not going to share at least some of your profits with your shareholders, we're going to tax you on what you're hoarding. The whole point is to stop companies from just sitting on these giant mountains of cash. They want that money flowing.
And this is a perfect example of how tax laws are always changing. If you look at the footnotes in the source, you can see this section got tweaked a bunch of times. In 2017, the wording changed from reserves to profits. In 2018, they fiddled with the rates. And in 2019, they limited which years it applied to. It just goes to show you that policymakers are constantly fine-tuning these things.
But of course, this rule doesn't apply to everyone. The law makes some specific exceptions for companies that are already tax-exempt, for companies mostly owned by the government, and for some specific financial institutions like banks.
All right, let's move on to the third and final piece of our puzzle, Section 5A. This one deals with a very specific type of investment that's common in Islamic finance, and it's called a sukuk.
So for anyone who's not familiar, the easiest way to think about a sukuk is that it works a lot like a bond. It's a financial certificate, it represents ownership in something, and it pays a return to the investor. So for our purposes, the big question is, how is that return taxed?
Well, when we pull up the actual text of Section 5AA, it might start to look pretty familiar. It says, a tax is imposed on the person who gets the return, and it's calculated on the gross amount of the return. Ringing any bells? It definitely should. And when you put them side by side like this, wow, their structure is almost identical. They both tax the gross amount that gets paid to the investor, and they both have that same exemption for anything that's already tax-exempt. From a tax point of view, the person receiving the money is treated almost exactly the same way. Okay, we've just torn apart 3 different sections of the tax code. One for money paid out, one for money kept in-house, and one for a special type of investment. So let's put all the pieces back on the table and see the whole picture.
This table really lays it all out, doesn't it? It makes everything super clear. Notice how Sections 5 and 5A are taxes on the investor, the person actually getting the money. But Section 5A? That's the odd one out. It's a tax on the company for not sharing the wealth. And honestly, realizing who is being taxed, that is the absolute key to understanding the purpose behind each of these laws.
And really, that brings us back to the core idea here. We've seen the rules, we know who gets taxed, and we know on what. So the real question to think about is, how do all these little incentives and penalties actually shape the decisions that companies and investors make every single day? Because that real-world impact, that's where this stuff gets fascinating.